Hey guys, welcome back to our channel. My name is Robert Wolf. I am an asset coach and tax strategist, and this channel is designed for you as a small business owner. Our goal is to go through and talk about what we call economic termites. You can see my book right there talking about economic termites. They are taxes, inflation, time, laws and regulations, and debt. And our focus with this channel is, as a business owner, is to take the articles, take the interviews, take the information that is being spread across media and translate it to what that means to you and I as business owners, and read between the lines and have an action plan to understand what is being said, what is being done, and how do we address it? How do we plan for that? So let's dive into today's article from the Tax Foundation, which I find to be a very good resource. So if you're ever interested in wanting to read more about different taxes, the Tax Foundation is a great resource that helps quite a bit, not just from a federal perspective, but also a state. So today's article is more focused on, I'm going to minimize my my screen here, but today's article is focused on inflation and taxes, and how inflation is going to cause your income taxes to go up. And I'm going to actually add sales taxes as well as your other areas of taxes are going to go up due to inflation. And so in the article, they do call it a silent tax, but it is not silent. It is very, very loud. And so, by the way, just so you know, the Federal Reserve, they have an inflation goal of 2% a year. So in there, the problem with fiat currency, paper money, government-backed money, is that if the Federal Reserve has a goal of 2% inflation, that means every 36 years, your money devalues, and that's quite significant. So if you can think about, our incomes increase, but it's because our purchasing power increases because things become, the dollar becomes worth less and we have to use more of it. And so when inflation creeps up quite a bit above that 2%, we have an issue. Now, you usually don't hear about things in inflation when inflation's below 2%, but at the end of the day, inflation is a taxation. And so let's go ahead and minimize my screen here and let's dive into this and see what this means. So as inflation rises, so will your tax bills in many states. So this article is specifically talking about state taxes, specifically income state taxes, but I'm going to insert here as well as the understanding of your sales tax. If you're buying goods and products that are going to cost more, you're buying a car, you have sales tax on it. You're going to buy eggs, you have sales tax on it. So those cost of goods increase, so does your tax burden. And so when incomes increase, and we'll find this out in the article, when incomes increase because of the taxation and employers giving raises, there's not a necessarily increased purchasing power. Sometimes those raises balance you out. And there's going to be an example in this article talking about that in Delaware, and how the taxation actually decreases your purchasing power because of that. So let's dive into this. Inflation is always called a hidden tax, okay? And it, like I said, it's not very, it is hidden, but we see it quite often. But in many states, oops, sorry, I'm not sure what's going on. There we go. Okay, in many states, it yields a far more literal tax increase as tax brackets fail to adjust for changes in consumer purchasing power. This is called brac creep. All right, and taxes are creepy. We understand we want to pay our fair share. We use public resources. We get that, but as it increases, the far creepier than the decor beginning to pop up in people's front yards as we enter the final weeks of October. Okay, so they're talking about Halloween, right? Inflation currently stands at 5.4%. Now, it's at the time of this article. We know it's higher now, being in January. Over the past 12 months, the highest increase in decades, which is still accurate today, is about 6.3% higher than when the pandemic began. Yes, actually, it's started a year ago when we had a shifting and changing in what? In presidents? No. Actually, the inflation results started when the new administration came in, but we put ourselves in an inflationary period when the CARES Act was passed in early middle of 2020. When the government throws trillions of dollars into the economy, reduces taxes, reduces you and I paying into the system through taxation, that puts a lot of money into the system, and that's what triggers and causes inflation. We have a low interest rate environment, so it makes it easier for buyers to borrow money, which is a way the Fed inserts cash into the economy, makes it easier for you and I to do things. So a dollar doesn't go quite as far these days, and compensating measures have been taken in a variety of sectors, such as Social Security. Recipients are going to see a 5.9% cost of living adjustment, which is great for them, but bad for us as a totality of society, because that means the costs going into Social Security, we're going to have to increase taxes because there's more drain on that pool of money. Okay, and so now you can make the argument, well, if I'm getting higher wages, then I'm putting more money into Social Security, which you get the idea, that's causing some of the issue for us as individual consumers. So you kind of see the teeter-totter, the two sides of the scale, to try to balance that out. And so when you have laws and regulations, one of our detrimental termites, when you have politicians, regulators making certain laws and rules to try to help everybody and their mother, and not allowing the market to correct itself, this is what happens. Okay, the largest increase in about 4 decades. 40 years. 5.9% is the largest in 40 years. So we're talking about, late in the 80s when we had high inflationary periods, early 80s. Wages are up about 7.3% during the pandemic, offsetting higher costs. So wages have gone up for those that are working, okay? Though it may be cold comfort for those who didn't see their own wages rise or who saw the value of their investments decline, okay? And that's not for everybody. Now, often overlooked, however, is what happens to state tax burdens when inflation is higher. When state tax brackets and standard deductions or personal exemptions are not inflated and adjusted, they lose value due to inflation, right? So again, your dollar is worth less, so therefore you lose value. Raising tax burdens in real terms. However, bracket creep, what we talked about earlier, occurs when more of the person's income is higher tax brackets because of inflation rather than higher real earnings. So you're getting a pay raise due to the cost of goods, but you're not actually making more money. You're just getting more money to pay for the cost of goods. Okay, so it's a net zero. So or not a real earning. Imagine, for instance, and here's the example of Delaware, a Delaware resident who made $60,000 in taxable income in 2019 and now makes $64,000. So you and I would say, hey, that's a great raise, $4,000 a year. That's quite substantial. Now, due to inflation, she hasn't seen an increase in real income because now her income's at $64,000, but the same purchasing power as in 2019 at $60,000. So there's that net. But if her tax income brackets aren't inflated, based on indexing of inflation, where her top marginal rate would previously be 5.55%, now she's at a $4,000 tax at a higher rate of 6.6%. Okay. Now her tax bill rose by $264. Now, the average person would say, oh, well, $264 is not a lot of money when you have a $4,000. It is when you have a net even. So basically, consider right now someone taking $264 away from your bank account just because, and that's what's happening here. Okay, so now if you're in a state that has a higher tax bracket, state tax bracket, have higher sales taxes, they do not adjust due to inflation, then you have a larger sum of money being pulled out of your pocket because, so you have a deficit. Okay, now if you talk about, let's say, like a state of California, where the inflation, where you have a year ago, gas prices were $2 less, or $1.50 less than they are today. Okay, so if you have a tax on your gases, guess what's happening to that? It's increasing. So not only are you paying more for each gallon of gas, but you are also having, that's part of your inflation, you're also being taxed on that income to pay for a higher tax. So it's a larger drain when you're in a higher tax state like a California. Okay, so it becomes a trickle where every dollar you spend, your income dollars, right? You get your paycheck. You've already been taxed by both Fed and state. Okay, Social Security, Medicare, right? You have all your taxes taken out. So now you have net income. Now you take money out of your checking account, and everything you purchase is being taxed with those dollars as well. So if the inflation's increasing by 6%, okay, that means that you not only have a 6% cost added to that, but you have a larger tax coming out of that as well. Does that make sense? So that's pretty substantial. So what do you have to do as a business owner? Right? Many times we got to raise our prices because our cost of goods, our materials, our cost of doing business increases. And so what happens to the consumer? Again, inflation. So you can see how it's all connected. Now the politicians want to make us feel like, well, we're all disconnected and it's us business owners that are the ones at fault. Well, no, not really, because we're all reactionary to you as politicians making these decisions. And so, we saw this in 2008. Yes, it was sucked that the markets went down over 50% due to 2008 and the financial crisis. By the way, were politicians and people who wanted to buy homes with when they didn't have any money, right? So we as a community, as a society, we're at fault. The banks, consumers, and politicians. Okay, and so of course, when the markets go down, people lose money. We as a government feel bad and we want to help. Well, that's when quantitative easing, QE, started kicking in, where the Fed started to funnel money into the system by not printing money, but by buying things, which is kind of the same thing, and which is buying what? buying aspects of government treasuries and that sort of stuff, which influx money into the government and a lot of yada yada yada. I won't go into all that, but so anyways, it's a big issue. Now let's see here. Now 41 states and the District of Columbia tax wage income, while New Hampshire taxes just income and dividend income. Of these 15 states, 15 states and DC failed to adjust brackets for inflation. 10 states leave their standard deduction, meaning that the standard deduction stays unadjusted, and 18 have an unindexed personal exemption. So taking together, you have 22 states and the District of Columbia. Can I say DC? I'm just going to say DC, okay? 22 states and DC have at least one major unindexed provision. 13 states failed to index any relevant major component. In some cases, they may forego a standard deduction and personal exemption, but all relative provisions are unindexed. They are Alabama, Connecticut, Delaware, Georgia, Hawaii, Kansas, Louisiana, Mississippi, New Jersey, New York, Oklahoma, Virginia, and West Virginia. Now there's no political association, right? You have blue and red states in this list, okay? So it's not necessarily based on a political situation. It's based on how they decide to collect revenue to run that particular state. The absence of insufficiency of cost of living adjustment in many states' tax code is always an issue. Well, it's always an issue when you have an inflationary issue like we do now, which was caused by what? The federal government and the Fed putting too much money into the system. Okay? So it's not our fault. It is a issue that is a issue just in general. To see how significant inflation can be, consider cap gains. Let's say that you purchased 10,000 worth of shares in 2001 and sold them for 20,000. So it goes through here, but both the Fed and state governments would treat as a capital gains on the 10,000. The federal government provides a but you can read that. Right? For some reason, I can't read that word. You don't have to be a genius to be able to read articles, but apparently I'm not able to do that. Rate on long-term cap gains, while most states do not. In real terms, however, the gain is far less than 10,000 because cumulative inflation during that period was nearly 55%. Making the real margin of $4,500. Okay. So now that's based on the cap gain of 10 grand. Okay. So now note the inflation index of tax codes alone cannot solve these problems, right? So we're not saying that that's what's, tax law changes can change this. No, there's a bunch of different things that changes. But if you scroll down now, if you take a look at this, it goes through each state of Those that are indexed, those have a flat tax or what, or no indexing or no tax. So it kind of goes through this based on the state. So I'm not going to spend a lot of time. You can go to the article in the description here and take a look at that. So what I wanted to just share was a quick little video, quick little note on, hey, we got to be very cognizant of business owners, how inflation is going to affect our business decisions. And that's our people too. So it's very important that we do take care of our people, because as we're seeing in today's economy, people don't want to work. So those that do, you want to reward, but we also need to be cognizant of cash flow and the cost of doing goods, and making sure that there's a price point for our consumers to still come to the door, still come to us and purchase product and services. So we really have a balancing act as business owners, right? It's art and science at this moment, especially if you're selling specific goods that are price sensitive to competition in your area. So anyways, hopefully this was helpful. If you like what you see, go ahead and subscribe, hit the little bell so you get notified. Give me a thumbs up. If you have any comments, please add comments. If you want to see any articles about other areas of economic termites, taxes, inflation, time, laws and regulations, and debt, let us know, so that way we can be on the look and be able to add some videos here for you and for to help you. So again, my name is Robert Wolf. I'm an asset coach and tax strategist, and I greatly appreciate you being here and spending the time with us.